I'd like to thank everybody for joining me today. Today, I want to go through another charitable planning strategy and focus on the Charitable Lead Trust. Charitable Lead Trust can be a great opportunity to really boost our charitable legacy, but also plan for taxes and other events. When we look at Charitable Lead Trust, what I'd like to take a step back and think and look at who charitable planning is for. Obviously, it's for those that are charitably inclined. If we're charitably inclined, we're looking for opportunities to do more for the charities that we're involved with. But also, charitable planning can be a great strategy for people that are looking to reduce income taxes, and also look at opportunities to reduce the estate tax. When we're talking about charitable lead trust, we're really looking at opportunities to reduce income taxes. And it provides a unique situation because we can actually use the charitable lead trust after we have had an income taxable event. So when you're looking at charitable lead trusts, it's a great strategy to really come in from the income tax planning side. So let's take a look at the mechanics of charitable lead trusts because they are a little bit unique. When we're looking at our client, the donor, the person that's going to be creating the charitable lead trust, they get to plan and make sure that the terms of the charitable lead trust meet their particular situation. They can be the trustee of the trust. They're going to control the investments of the trust. But first step is getting the trust formed and signed and enforced so the client can now transfer property to the charitable trust. Now, with the charitable remainder trust, we have to put that property in before we do a sale of the property, before we have that taxable event. With the charitable lead trust, when we transfer property in, this can be real estate, this can be part of our business, this can be cash. This could be a cash contribution. So if you've had that charitable event, you've exercised stock options, you've sold a piece of real estate, after the income tax event has been triggered, now we can take that cash, transfer it into the charitable trust, and that's going to generate our charitable deduction. And we'll come back and talk charitable deduction and how that's calculated. But once the property is in the trust, now that cash, that property, whatever it is, can be reinvested inside the trust into a liquid portfolio. That portfolio is going to be used to pay an annuity stream during a set period of time to the charity. So that annuity stream, think about that. That's 5%, 6%, 7%, whatever you want to be able to give to the charity now. So if we set this trust up for 10 years, 15 years, whatever that term is, during that trust term, the charity is going to receive that payment. So reverse, think about this when we've talked about charitable remainder trust. Charitable remainder trust, that annuity stream went back to the donor. In this case, the income goes to the charity. And at the end of the trust term, whatever's left in the trust goes back to the donor. And this creates a great opportunity because now we can benefit our charities now. The advantage of that, and what I've seen from clients that I work with that are charitably inclined, they love to see the good that their money's doing. They love to see that they can get money to that charity now and see that charity thrive and do whatever its charitable purposes are. But at the end of that trust term, that can come back to the donor, or if we want, we can use that in part of the client's estate planning and have it go off to their kids, grandkids, or wherever it's supposed to go. But what I like is we've now created a tax deduction, benefited the charity. Now, when our clients retire or get to that point in life where they want to have money coming back to them, they can get it back. So let's look at this. Let's just take a hypothetical case. And so I've just got a round number, a gift amount of $1 million. So if we have a client there again that has $1 million either in cash, property, whatever it is that they want to transfer to the Charitable Lead Trust. In the trust design, we're going to decide, how long this trust should last. So it could be 5 years, 10 years, 15 years. I'm just picking 10 years and 15 years so we can see how those two examples would play out. But the client's going to decide what that is. And remember, at the end of this term, whatever's left is going to come back to our client. Our client in the design of the trust, they're going to decide what is the annuity percentage. What is that percentage that's going to pay out to the charity each year? So if this is a charitable lead annuity trust, that 6% is going to be $60,000 a year. That number's not going to change. And every year the trust will make that $60,000 payment to the charity that we've designated. There again, that charity can be an irrevocable designation, a revocable designation. It can be set up so our client can really be flexible in how that money is dished out every year and who it goes to. So if our clients, if they have charities that they have a long history with, that probably won't change. What I find is clients that aren't, as seasoned in their charitable giving, that they spread that annuity payment out as they see fit and as they grow in their charitable giving. As we do this, we're going to have money invested inside the Charitable Lead Trust. That money's going to be invested, part of it for long-term growth, part of it to create that $60,000 a year income. There again, our client's going to determine what that percentage is and how much is going to the annuity. So that's something we, as we develop the financial planning inside the trust, we'll do that based off of what the charity needs to pay out. Now, if you look at this trust is going to generate a large charitable deduction. Now, that charitable deduction is going to be a combination based off of how much money we're putting into the trust, how long the trust period is. So you can see the longer the trust period, the bigger the tax deduction. It's going to be based off of the amount of the annuity payment, the percentage. So there again, the higher the annuity percentage, the bigger our deduction. So if you look at this, if we put $1 million in for 10 years, 6% annuity, that's going to give our client a $481,000 tax deduction that they can use now, and they can roll it over for an additional 5 years. So that creates 6 tax returns that they can use up that charitable deduction. This creates that planning opportunity, because in this scenario, let's assume our client has, exercise stock options. They want to reduce the tax hit of those stock options. So now they put the $1 million into the trust for 10 years, pay out $600,000 over the 10-year period to the charity. They've created a $481,000 deduction, which is the present value using the IRS's calculations of those $600,000 in payments going to the charity over a 10-year period. But the client gets to write that off now. They get to use that tax deduction now while they've got assuming high income tax reporting years. At the end of the 10 or 15 years, depending on the length of the trust, whatever's left in the trust reverts back to our client. And now the client can use that for retirement, for whatever they want. But what the Charitable Lead Trust does is it creates an opportunity to eliminate a lot of tax, benefit the charity, and really comes back to, it can be a great planning strategy for clients that are charitably inclined. They get to benefit the charities that they're working with. It can be a great tool for clients that just want to get that tax deduction now and offset those high earning years. But there again, great tool, great thing to look at. And if you have questions about Charitable Lead Trust or other charitable planning, feel free to reach out. I appreciate you being on, and we'll talk later. Thank you.